John, I haven't seen you in a while, man. How's life in New Orleans?
Ricky, it's good to be on the show. Life in New Orleans is good. You know, I've got family here. I've got eight nieces and nephews here, two sisters, my parents, good friends that I grew up with, and it's a holiday season, so I really can't complain.
Nice. That's a great mentality. Life in Denver is pretty good. Holiday season's coming up. I got my wife here, and it's been a fun place as I start this sort of new chapter of my life. Even though I was here for the old chapter of my life, it's still a fun city to be in. For those who don't know, John Rotonti, he's a portfolio manager for Bastion Fiduciary, where he runs the quality only portfolio. The largest home builder in America, D.R. Horton, said, "We expect sales incentives to remain elevated in fiscal 26. And the translation for non-financial folks is we need to cut prices on new homes, which, John, is surprising to me because there is a housing shortage in America, broad scale, as people are locked into low existing rate mortgages. They don't want to move. And you would expect that new home prices would continue to climb based on that. And yet we hear from the largest home builder, no, we still need to add a lot of these incentives. And I know you pay attention to the home building market. What are you seeing there?
What's going on with home builders is we underbuilt coming out of the global financial crisis. I read some research recently that I actually posted to X. It's basically a white paper from a professor from Harvard and a professor from Wharton, which they looked further back, and they actually said that we've been underbuilding since the 1970s. There were periods where we accelerated building. So we obviously were overbuilding for a period of time going into the global financial crisis, 2008, 2009. But if you look at it over that extended period of time, we've been underbuilding since the 1970s. According to this white paper, at least. I was reading from McKinsey, and I have this here. So McKinsey says that, and this is a quote, closing the gap by 2035 would mean building 9.6 million housing units on top of the roughly 850,000 units per year already expected from 2023 to 2035. So they're saying, we need 850,000 units per year, and then on top of that, another roughly 10 million units. Lowe's CEO, the home improvement retailer Marvin Ellison, he did an interview with Barron's maybe 2 months ago. He says the U.S. needs to build 18 million new homes by 2033 just to meet current demand. So, there is a I think massive shortage of homes. Other people think we're short anywhere from 1 to 7 million homes. I don't know what the number is, but I definitely think that we're underbuilt here in the U.S. Coinciding with that, existing homeowners are locked in to their homes because they have 3 or 4% mortgages, and so they're not selling. And so we have high demand, particularly among entry-level starter homes, like that sort of millennial that's in their prime home buying year, prime earning years, want to starting a family, want to buy that first house. Well, they can't. And so what has happened, because home builders, can't build enough homes. There's lots of reasons why they can't build, because basically they can't build at a price point that these millennial homeowners can afford, because labor's up, lumber's up, land is up a lot, regulation is at the local level is extremely burdensome. So for a lot of reasons they can't build. Also, local regulations in a lot of parts of the U.S. mandate that you build a minimum square footage, and so these home builders have to build homes large enough to meet these minimum square footage mandates. So for a lot of reasons, they can't build affordable homes. Existing home supply, there's none of that. because people are locked into their 3 or 4% mortgages, while 30-year mortgage rates are now 6.2%. So what has happened is since 2019, home prices have increased 50%. And you combine a 50% increase in home prices with mortgage rates that were double what they were 5 years ago. And then you add in the resumption of student loan payments. If that takes place, that's going to further, make housing even more unaffordable and out of reach for a lot of people. And so we've got this supply-demand imbalance that is, just making housing really unaffordable right now.
So like our macro discussion, it's also not difficult. Housing is it's not just a national thing. So something, and this is just personal experience, so we'll see how much economic data there is here. But I've noticed in Cincinnati, my friends and family there, they're buying homes. They're not delaying having families. I'm in Denver, Colorado. There's among my social circle, people are not necessarily getting married as much or having children and buying homes. And for a lot of prospective home buyers, renting is still significantly more affordable. And yes, you can build equity, but do I want to pay property taxes? Do I want to put $100,000 on a down payment to buy a home? And then the other issue is where a lot of new home construction is, John, is on the it's on the outskirts more of town. You're 20 to 30 minutes away from a city. So people are doing the math financially and saying, maybe I'll spend $1,500 to $1,800 on a 1-bedroom or $2,500 on a 2-bedroom, and I get to be in a area, a better, not necessarily better, but area that's closer to the city. Or do I want to go buy a new home and have a 30 to 40-minute commute? And I think that story is probably playing out in a lot of other regions in the US as well.
Absolutely. And that was accelerated since COVID, obviously, because, in the early days of COVID, people wanted to get as far from the crowded cities as they could, right? And they wanted that yard and that pool so that they could socially isolate themselves in a pleasant way. So they have a big yard, big pool, a big deck. And so, yeah, I think COVID accelerated that move even further away from the cities. You're right. These decisions are made on local levels. Absolutely. But when it adds all up, in the end, housing, is a very important part of the U.S. economy. So new housing building permits are one of the 10 leading economic indicators. Housing makes up 35% of CPI, shelter inflation basically, and 15% of U.S. GDP. So it's really important. Not only that, it has a multiplier effect on the economy. So every $1 that goes into building a new home cascades throughout the economy, and it actually boosts overall U.S. GDP by around $3. So there's that multiplier effect as well. It's fascinating to follow the housing sector and, home related in general, home services, anything related, building materials, supplies, because it does have this profound impact on our economy and on inflation.
I know your investing style is not 1 to 3 years. It's 10 to 30 years.
10 to 30.
Is this an area that is investable to you, or if at all, how are you approaching it?
So definitely, I've got housing exposure in the portfolio. We've got one home builder, and then primarily playing it through building materials and building product companies, that sell everything from roofing to insulation to, you name it, to the home builders. Some of these companies also provide value-added services. So they'll not only do installation, for example, but they may actually build something offsite in their automated factories, transport it to the home site, to the job site, and then install it. And so, they're doing like custom trusses, custom millwork, custom doors, windows, anything like that offsite. Saves a lot of money, saves a lot of time, saves a lot of waste as far as, the lumber that needs to be used and whatnot. And then they actually install it as well. So anything involved in that is fair game for the portfolio. And then I've also got a lot of HVAC exposure to the home as well.
Anything else you want? I want to get to the AI build out story, which I'm curious to hear your thoughts on. But anything else on housing you want to address or talk about before we go to the other?
I'll just say, the housing, the bear argument against my thesis that we are underbuilt is that baby boomers own a lot of homes, and at some point they are going to release these homes onto the market. And that point may be when interest rates come down and they want to downsize and buy a condo, or it may be when they, pass and leave the house to their heirs and the heirs put it on the market. So that's, the bear argument. At this point, I believe that, millennials are the largest age cohort in U.S. history. So at this point, I believe that demand from millennials and first-time home buyers will be enough to overwhelm this flood of new homes coming onto the market. Also, we don't know over what time period this flood of new homes will take place. It's not all going to happen in 1 year. It's going to happen over, several years or decades. And so right now, I'm not as worried about that, but it's definitely something I need to keep a close eye on. And the last thing I'll say is those homes that these baby boomers own are very old, and they need a lot of work done. So in 2011, and this was in the Home Depot Investor Day last week, in 2011, 42% of homes in the U.S. were over 40 years old. Today, 55% of homes are over 40 years old. And so these homes are going to need a lot of work. And so, that creates opportunities for not only the home improvement companies like a Home Depot or a Lowe's, but also these building materials and building supply companies that I mentioned as well. So I'm not sure how it all plays out in the end. I just still believe at this point, and I reserve the right to change my mind, but I believe at this point that housing is really important to the U.S. economy for the reasons that I said. 15% of GDP, 35% of inflation, but also because, housing is an important part of the American dream. It's a foundational pillar of the American dream. And for many of us, our home is our largest financial asset and our biggest source of net worth. And so, one other thing about net worth, there's record home equity in the U.S. at this point in time. And so even though there's not a whole lot of new home building, and even though there's not a whole lot of existing housing turnover, there's record home equity. And so when interest rates are starting to creep down and home equity lines of credit, HELOCs, typically are on that shorter end of that interest rate curve. And so when the Fed starts lowering interest rates, as they are now, home equity lines, rates are coming down as well. And so that could spur a sort of, home renovation cycle where people that are stuck in these homes because of low interest rates take out home equity, which is at a record, to do a pretty big renovation on their homes.
Can we talk about Home Depot specifically? So Home Depot, I think one of the big parts of the Home Depot thesis was that this is a company that can sort of maybe keep. They're not going to shoot the lights out necessarily on earnings or sales growth because it's a pretty big company. But one of the ways that they were rewarding long-term shareholders was through very diligent share buybacks, share repurchases. And John, it seems that has sort of, I don't know if it's slowed down or stopped, but I think that is an important wrinkle in the Home Depot story is, yes, they may get some earnings growth from people renovating their homes, but if they're not playing the financial engineering game, for me, I look at that company and say, I don't know, that's a index fund versus buy Home Depot stock. And if you're not playing the financial engineering game, for me as a shareholder, I'm a little less interested in it.
So we own Home Depot in the portfolio. You're exactly right that they have a new CEO, newish CEO, and the strategy there has shifted to more more of an acquisition strategy to go after what they call the complex pro. So Home Depot is unique from Lowe's in that 50% of its business is pro compared to, do-it-yourself or retail, mom and pop. Lowe's has a much smaller pro business, growing pro business, a profitable pro business, but smaller than Home Depot's. And Home Depot separates its pros into sort of like everyday pros and like really complex pros, which are managing like apartment buildings and stuff like that. And so they made 2 acquisitions recently. They bought a company called SRS, and then they bought a company called GMS to go after this sort of repair and maintenance complex pro business. And they did that with some debt. And because they made these 2, material acquisitions in the last, 2 or 2.5 years or so, I'd have to check my dates on that. They have put their buybacks on pause. Home Depot is a company that has traditionally benchmarked, which I love, all capital allocation decisions against the return that they get from buybacks, which is a great practice. They said on their Q2 earnings call that these acquisitions are higher return than buybacks or even opening up a new store. They believe it's going to be their highest return on their highest ROIC use of capital. So we have to wait and see if that's correct, if that's right. But yes, right now they are more focused on making these acquisitions to go after the complex pro. There's a new player in the market with Brad Jacobs and QXO. Brad Jacobs is going to try to roll up the building materials and building distribution market, basically. And he has a goal to achieve 50 billion in sales. So buy several companies, roll them up, and I don't know if it's 5 or 10 years. I can't remember. You can check me on that. Have a company that's generating 50 billion in revenue. He's a little behind. He's only bought 1 company so far, Beacon Roofing. And Home Depot and Lowe's, by the way, are putting up a pretty good fight. And actually Home Depot, the most recent acquisition, GMS, QXO made a bid for it first. And then Home Depot came and took it from them by offering a higher bid. And so this is a high margin, high return on invested capital segment of the market they're going after, this complex pro. And I think that's why they've put the buybacks on sale right now. Also because they need to pay down the debt.
This episode is sponsored by Capital Area Planning Group. Capital Area Planning Group is a fiduciary wealth management firm that specializes in helping high net worth individuals and families navigate the complexities that come along with managing concentrated stock options, multiple income streams, and an ever-changing tax code. While our team of certified financial planners are well-versed in all things personal finance, our areas of expertise include equity compensation, estate planning, and multi-year tax planning. At Capital Area Planning Group, we believe in pricing transparency. That's why our fees are posted on our website, right alongside the various services we perform on behalf of our clients throughout the year. If you're tired of receiving the same cookie-cutter advice from your financial advisor, then don't wait. Reach out to us today at capgllc.com to experience a better approach to wealth management. Again, that web address is www.capgllc.com.
Let's talk about something much more exciting. Maybe I should have started with more exciting and then given the vegetables of home builders at the end, but that's the AI build out. And John, you are proudly allergic to FOMO. So I'm very curious to hear from someone who is quality only, I'm not going to say valuation focused, quality only, valuation focused, allergic to FOMO, how you're approaching the AI build out.
So the way that I've approached the build out, so I'm an infrastructure investor. You said at the beginning I was quality only, and that's definitely true. But technically I manage the Bastion Fiduciary industrials and infrastructure portfolio. Now I have a very broad and wide definition of industrials and infrastructure. And so a lot can be included in that. But as an infrastructure investor, I'm obviously paying very close attention to the AI build out because that's the biggest infrastructure build out in a generation, without question. So that's the first thing. The second thing is a lot of the companies that are benefiting the most from AI at this point are some of the best companies in the world. Just, in my opinion, but almost without question. I mean, it's hard to argue that a company like Taiwan Semiconductor, which is not in the portfolio, but which I own personally, and by the way, it's not in the portfolio because I manage a domestic-only portfolio. It's hard to argue that Taiwan Semiconductor is not one of the highest quality, profitable growth companies in the world. Well, it also makes 95% of the AI chips in the world, and so just from a quality perspective, a lot of the quality companies are also involved in building out AI. That's the first thing I'll say. So mega cap tech, very high quality based on the lens that I use to think about quality. And so, we've got some mega cap tech in the portfolio. But then, beyond that, the way that I think about quality is businesses that find that have a long history of adapting to whatever the new technological innovation of the day is, right? And so I have companies that are in the portfolio that are literally 100 years old, or more. I have 4 or 5 of these companies that are around 100 years old, but they're so adaptive. Their cultures are so agile, and they are so inventive, either through internal invention and R&D, or because they're acquiring companies and new products and new technologies, but they stay ahead of these technology trends. So even though these companies are 100 years old, they are major suppliers into these AI factories. So it could be electrical equipment that's going into the AI factories. It could be HVAC, thermal and cooling equipment that's going into the electrical factories. It could be copper cabling, fiber optic cabling, little connectors and sensors that go into these data center racks. Anything like that, generators, backup generators, battery power, anything like that. So, these companies, Amphenol is our largest holding. I think 30% of Amphenol's revenue comes from AI, but most of our other other companies that have exposure to AI have less than 30% of their revenue coming from AI. So TE Connectivity has less than 30%. Eaton has less than 30%. Train Technologies has less than 30%. GE Vernova has less than 30%. Quanta Services has less than 30%. All of those companies are, multi-industry, sort of broad industrials that sell into multiple verticals, AI being one of 6 to 10 to 12 verticals. And so that's kind of how I'm thinking about it. I don't wake up in the morning saying, what is the, hot AI company of the day? Or what is this native AI company that I think the stock is going to go up a lot this year or next year? I don't ever ask myself those questions. I ask myself, what are the highest quality, broad-based, diversified industrial and infrastructure companies I can find? And how are those companies positioning themselves to benefit from the AI infrastructure build-out because of their agility, because of their adaptability, because of their resilience, because of their cultures of always trying to have products and services that are relevant in the modern day and age. And so, it's those companies that can, constantly adapt to the next gen technologies and stack new S curves on top of their original growth curves, that I believe create, the most compounded value over the longest periods of time, because they're adapting to whatever the world throws at them. And so that's how, there's always hot AI companies that sell this part into the AI data center, or this wire into the AI data center, or they're coming up with this new silicon to put into the AI data center. Very little, if any of that interests me, because they are, completely and utterly dependent on the AI build out. And if the AI build out goes away, then those companies could go away, hypothetically. But if AI goes away, Amphenol does not go away. TE Connectivity, Train, Quanta, GE, they don't go away because it's, maybe a third or less of their business. And they are, almost indispensable to their customers, not almost, they're indispensable to their customers across, like I said, a dozen different verticals in a lot of cases. And so that's what I'm looking for. Companies that can stay agile and adaptable and relevant and resilient across cycles and across time. And the companies that can do that have the highest terminal values. And the companies that can do that create the most compounded value for shareholders over time, in my opinion.
I think it's a pretty strong opinion, John. I think you're one of the reasons I wanted to have you on the show is because you think a little differently. You don't wake up. What is it? You don't wake up in the morning saying, "What's the hot AI company?" You wake up in the morning saying, "What is the flexible infrastructure company that can be around for 10 to 30 years?" And let's talk about Amphenol.
Yes, that are going to find a way to benefit from whatever the technological trend is. Exactly. Yes.
So let's talk about Amphenol, because that's a company that I'm not very familiar with, and just on a personal level, is someone who invests in individual stocks. If I hear you say this is my largest holding, that's one that I want to learn more about. And I know that they've been around for about 100 years, and yet they increased sales by about 50% last year, which is not something you expect to hear from a mature company like that. They produce fiber optic cables. But why is this, and I know some of this must be performance because the stock is up like more than 70% over the past year. But this is a company that you must have a lot of conviction for to fit in your portfolio like this. Why do you have so much conviction in Amphenol?
Yeah, and so they do sell fiber optics. They also sell variety of different connectors that are not fiber. The reason I have so much conviction in Amphenol is because Amphenol, I think, is the best acquirer of businesses I've ever come across, pretty much. And if I'm taking that 10 to 30 year outlook that you mentioned, which I am, I'm looking for companies that I think have the longest duration of per share growth. The rate of growth means much less to me. The rate at which a company is growing means much less to me than what I think is the duration of growth. And the only area that I've ever found to believe to have almost unbounded growth is companies that can consolidate a highly fragmented industry off the back of an acquisition skill set that they have built up internally over decades. And that's what Amphenol has done. They are exceptional at identifying acquisitions, paying a good price for those acquisitions, integrating those acquisitions, creating a lot of value from those acquisitions, and using those acquisitions to, like I said, stay ahead of technology curves in a lot of cases. And I say ahead of technology curves because what Amphenol does is, so Amphenol, they have major components in NVIDIA server racks. This is only one thing that they do, but that's the exciting thing that they're doing right now. They have a core component called a backplane that connects a bunch of wires and GPUs in an NVIDIA server rack, and they are a preferred partner to NVIDIA. They have a seat at the table when NVIDIA is planning their next gen architectures, and because of that, they know where the technology is going before anyone else, and so that has allowed them to stay ahead of technology curves across cycles and time. They're excellent at making acquisitions, and they have a very decentralized corporate structure to where they have a CEO, this guy, Adam Norwitt's his name, but they have 140 CEOs basically because they have 140 businesses. They've acquired over 200 businesses. They've merged some of these internally. So they have 140 basically, whatever you want to call them, presidents, general managers that literally manage their business as if they were the CEO. And the combination of this very agile, entrepreneurial, decentralized corporate structure, plus this acquisition platform skill set that they have built up over the years, has made the company, I think, extremely hard to replicate. But more importantly, I think that extends their runway of profitable growth for what I think is almost as long as, and the thing is, Adam Norwitt is not the founder. Like, this is a 100-year-old business. He's someone that grew up in this culture, learned about this culture. But that's all he is. He's just born and bred in the Amphenol culture. So when he's ready to retire, I've got strong conviction there's someone else there that has been born and bred in that Amphenol culture that can, take that torch and keep that flame going. And that's what it is. It's the culture, and it's this acquisition platform that they have built over the years. And I think it creates almost unbounded growth when you can consolidate a fragmented industry like this.
So we'll do a thought experiment. Let's say, you said NVIDIA is the exciting thing and the AI build out is the exciting thing right now. Let's say, and there's no reason to believe this would happen. Let's say the partnership with NVIDIA goes away. Let's say investors immediately cool on the AI build out. I'm not saying this will happen. This is a thought exercise because you look at companies with optionality. What happens to Amphenol? What can they still do if they don't have an AI build out going on?
There's no question, Amphenol stock would fall 20 to 30%. In my opinion, if that were to happen. It's a high multiple stock. Their AI business is growing 100% per year. That's a key performance indicator the market is focused on. And there's no question that the stock we would lose a third of its value. But I think over time they would be able to backfill that value with this acquisition platform that they have, I don't know if perfected is the right word, but they've built up this skill set as well as any company I've ever studied. I think that's what would happen. But like Amphenol, for example, 15% of its revenue comes from aerospace and defense. Okay. And what they do is they sell these connectors into industries and into verticals where it's an absolutely mission critical part of the system, right? And so these connectors have to work under extremely harsh conditions. So if we're talking about aerospace and defense, or even we could add space on top of that, they sell connectors into satellites and space vehicles. Okay. If you're talking about aerospace and defense and space, you're talking about vibration from turbulence, extreme vibrations. These things cannot loosen. They cannot break. They cannot falter because then you have, it's life or death, right? Extremely cold temperatures, extremely wet temperatures. They sell these things into subsea systems. And so these connectors have to provide 100% reliability. That's what they're selling to their customers is reliability. Our stuff is not going to break and fail on you. That's the value proposition. And because they're selling reliability, they have pricing power because these connectors are small and they're very, they account for a very small percentage of the overall cost of a project, very small percentage. And so someone is not going to switch out an Amphenol connector to save 10 or 20 or 30 cents or $1 or $2, whatever it is. So that gives them a lot of pricing power. And then, with something like aerospace and defense, these connectors are built into that platform for the life of that platform, which could be 30 or 40 years, right? And so, that's just one other vertical to talk about. But, I think they would be able to backfill the 30% of lost value that would come if NVIDIA canceled their partnership and AI CapEx went away over time. I don't know how long it would take by making new acquisitions. That's basically what I think would happen. You mentioned that I said AI. You mentioned NVIDIA being exciting. NVIDIA is almost, and we own it in the portfolio. It's almost oddly cheap. Like it's strangely cheap. And I know people that are listening to this are going to say, yes, but NVIDIA has been almost violently cyclical in the past. And I'm fully aware of that. Okay. Like fully aware of that. And when you have cyclical stocks, you have to really be careful about the earnings in that PE ratio, because if when earnings are elevated, when the denominator is elevated, it could indicate a low PE, but that could just mean that earnings are about to fall off a cliff, and that low PE is really not low and it's misleading. I just don't think that's the case with NVIDIA. And it's almost like weirdly cheap. And so the stock's at 180. If you think it's going to do $6 in 2026, in calendar 2026, because they're on a weird fiscal year. If you think they're going to do $6 in calendar 2026, that's a 30 PE. But if you think they're going to do $9 to 20 PE, and believe it or not, the deltas are that large because AI is just moving so fast and it's so hard to model this stuff. It's so unpredictable. If you look out 2 years at calendar 2027, if you think they're going to do $10, it's 18 PE. If you think they're going to do $12, it's 15 times earnings 2 years out. I don't think $12 is completely unrealistic 2 years out. And so it's possible NVIDIA is trading at 15 times earnings 2 years out. It's weirdly cheap how the market has sort of soured on NVIDIA recently.
The other topic I want to hit with you, John, is buybacks, because this is something that when we were working at the Fool together, you encouraged me to look at, is really focusing on the capital allocation strategies that companies employ, and these seemingly boring companies that are able to maintain earnings and buy back shares in a diligent way over long periods of time can end up really outperforming. I remember one you talked about was O'Reilly Auto Parts. And one we've also seen, AutoZone, Dillard's, even.
Home Depot was one, as you mentioned back in the day. Home Depot was one.
And that's why I asked you about Home Depot is, hey, they've changed this strategy and it seems maybe not good in the long run, but they're making a case otherwise. And this is something that has really become something I look at as an individual investor, because I know I don't think I can find the next NVIDIA, but maybe I can find the next Dillard's, because it's easier, I think, to spot management teams that are really focusing on buybacks. And the two that come to mind to me, and I can get into them if you want a little bit more, are PayPal and Abercrombie and Fitch. I think are doing it in interesting ways. The trouble with buybacks, though, is that management can get into trouble when they employ them. So there are lots of other examples where management teams buy back stock at all-time highs, and it turns out to be a really bad decision. With retailers, there's ones, I think retailers were taking out debt in the 90s to buy back a lot of shares, and then you create a problem where you've taken out debt to buy back your own shares, and you've trapped yourself in a vicious cycle. As someone who pays attention to capital allocation a lot, how do you look for companies that are doing buybacks in a sustainable and in a way that rewards long-term shareholders?
Topic near and dear to my heart for sure. So the first rule of buybacks is you don't want to be buying back stock if the stock is too expensive. But you really don't want to be buying back stock if the business is deteriorating. You mentioned retailers like, Bed Bath & Beyond went under, it liquidated, I think. It was buying back stock pretty much till the end. Everyone knew that was a dying business pretty much, right? And so the last thing you want to do is buy back stock if you're facing, if the industry you operate in is facing headwinds as opposed to tailwinds, if your own business, there's something wrong with the business model, if your moat is deteriorating, because you're just lighting money on fire, because you don't have a growing intrinsic value that can bail you out at some point in time. So that's That's when you don't want to buy back stock. If your intrinsic value is shrinking, if your sales and earnings are shrinking, I'm not talking about one quarter. That's fine. Everyone has a bad quarter or two. Some companies have a bad year or two. I'm talking about a consistent downtrend, quarter after quarter, year after year of shrinking top and bottom line. Do not want to buy back stock. Now, the question is, what if the company is in stable mode and earnings are stable? They're not growing, but they're also not shrinking. And you believe, as an analyst, that they can maintain stable earnings into the future. So you don't think earnings are going to grow, but you also don't think they're going to shrink. In that case, a no growth company, earnings are stable. Okay. If that company has a 100% free cash flow conversion, so if it's turning 100% of reported net income into free cash flow, so if it's free cash flow divided by net income is 1 or more, and if it commits to using all of that free cash flow to buying back stock, and if that company is trading at 10 times earnings, so trading at 10 times earnings are stable, flat, and it's using 100% of its free cash flow to buy back stock, that company trading at 10 times earnings can buy back 10% of its stock every year and grow earnings per share by 11% into perpetuity. Forever. That's the math on that. And so you have a company that's not growing, not making acquisitions, but it has this internal engine that it can still grow earnings per share by 11% in perpetuity, just because of buybacks. Now, the key there is the low PE, 10. I'll show you the math. So if that same company, stable earnings, they're not growing, but they're not shrinking, 100% free cash flow conversion, uses all of its free cash flow to buy back its stock. If that same company is trading at 6 times earnings, okay, PE is 6, it can buy back 17% of its stock every year and grow earnings per share by 20%. So the lower the PE, the more power there is in boosting and growing earnings per share just from buybacks for a company that's not growing. So it's pretty impressive. I'll give you a case study. So I have two. So 2 companies in my portfolio, United Rentals, and this is a portfolio I manage for clients, ticker URI. So this company had 95 million diluted shares outstanding in 2015. They now have 65.5 million diluted shares outstanding. So they've decreased their diluted shares outstanding by 30% in the last 10 years. On average, over the last 10 years, they've bought in 4% of their stock per year, reduced their shares outstanding by 4% on average per year. Over those 10 years, 2015, this is through 2024, through year end 2024, their earnings per share have grown from $8 to $43. So their earnings per share have compounded at a 20.6% CAGR, almost a 21% CAGR. And here's where it gets really good. Over those 10 years, they spent $7 billion buying back stock. They bought in 28.5 million shares. That means they paid an average price of $248 per share. URI today is trading at $850 per share. That should be in a textbook, right? That's the textbook case of capital allocation. They've reduced shares outstanding by 30% of the last decade, average annual share reduction of 4%. And they've bought in, like I said, they bought in 30% of the stock at an average price of $248 compared to a stock price today of $850. And I think the stock's worth 1,000-ish. So they're buying it at a discount to what I think the stock is worth today. That's powerful.
Last thing I want to talk about, this is on more of a personal level. I'm sort of managing a period of unemployment. Right now, my plan is I'm trying to grow this show. I'm trying to find some freelance work where I can. I'm also studying for a financial planning licensure. And I know this is something that you went through too after You left the Fool. This was something that is difficult no matter who you are if you're going through it. So how did you make your way through that wilderness, and any advice for those of us still in it?
Yeah, so I left the Motley Fool in March of 2023, and I started at Bastion Fiduciary in August of 2024. And so, I was unemployed for almost a year and a half. And it was extremely humbling, and discomforting at times, for sure. When I left the Motley Fool, I had a big network of professional investors, mainly in the mutual fund world, portfolio managers and analysts that I was not only connected with, but friends with in a lot of cases. Like, we became friends over the years. And I thought that I was a pretty good investor with a good skill set and a good resume. I was the head of investor training and development at the Motley Fool, for example. I had written a book. I'd been on podcasts. And so I thought that, the combination of the resume, my passion for investing, and my network would land me a job quickly. And that was not the case. Either timing was bad, or I got some flat out no's. We don't want you. You're not right for us. So it was humbling, for sure. And what I did was I stayed active, like you're doing. So I started the J Rowe Show. I started that podcast where I was interviewing portfolio managers about their investing process, mainly philosophy, but mainly process. And I got lucky, Ricky. Through that podcast, my current boss, the founder and CEO of Bastion Fiduciary, he listened to my very first episode with Bill Nygren. He random cold emailed me and said, "Hey, really like that. Would love to just chat sometime." And, we got to know each other. And one thing, we eventually offered me a job like 6 months after our first conversation. But yeah, I stayed active. I didn't, just kind of stay in bed all day and not do anything. I continued to network, even above and beyond just the podcast. And I also used that time to do two other things, Ricky, I would say, to really, really focus on the craft of investing. So I had a lot of time on my hands. And so that is when I dove really deep into analyzing some of the companies on my watch list and in my portfolio to get to know them even better. I got a lot of mentorship during that time from some of these investors that I was close with. And so I really improved my skill sets in some of the more technical and valuation modeling side of things. I took a class from an organization called Fundamental Edge from a former, very qualified and successful hedge fund manager. He's a former hedge fund manager, worked at worked at Viking, worked at Citadel. So yeah, just tried to better myself, improve the craft, take classes, stay networking. And then the other thing I did was to relax and clear my head. I did a lot of traveling and a lot of hiking. So I got outside a lot. And that was spiritual for me in a way. Just being outside in the mountains, in the mountain air, helped me a lot, I think, as well.
I think that's wise. For me, it's staying active has been, and when I left, I had I had a leg injury that made it difficult for me to hike, but staying active in this period has been fundamentally important to me. And I also learned, one of the things that I learned about myself is that I cannot just work from home. I need variance in my day. So I got a co-working membership. And I knew that is something that, even though it was something I was hesitant to spend money on, because I'm like, this is $150 a month. I'm on severance right now. I need to invest that in myself to get, studying done, to get outside work done, and to get out of my own headspace in my home office. So you kind of mentioned some of the things you did. Those were a couple of things that I learned about myself. I needed to really stay active. I needed to get up early to the extent I can, not to the extent I can. I need to get up early and get momentum in my day, and I need to get outside of my home office when I can. Right now, I'm in my home office just for recording purposes. But I'm curious if there's anything in that period that you learned about yourself.
I would say very similar. I don't love working from home. And so I didn't do the co-work space, but I spent a lot of time working from coffee shops, a lot of time. I love coffee, but I also just like being among people and people watching. And I will say this, if the strategy that I manage continues to grow and scale, and I can really build up that AUM, I will open up an office wherever I'm living. Now I'm in New Orleans, but I will open up an office. And if I get to the point where I hire a team at some point, an analyst or two, they're going to have to be in that office. And so that is a long-term goal of mine, is to have an office environment.
Let's end it there. John, I really enjoyed this conversation. John Rotonti is a portfolio manager for Bastion Fiduciary, where he runs the quality-only portfolio. I hope we get to do this again. I really enjoyed the conversation.
Ricky, thank you for having me. Always love talking to you. And I think you and Malcolm are building something absolutely wonderful with the podcast.
Appreciate that.
Information shared in this recording and by its guests represent the views and opinions of the guests and does not represent the views or opinions of the host. This content has been made available for informational and educational purposes only. This content is not, nor is it intended to be, a substitute for professional financial advice. It is always recommended that you seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your personal financial situation.